Pose that question to Rashesh Shah, the Chairman and CEO of Edelweiss Financial Services, who joins us now to talk about the business that has been growing phenomenally well over the last many weeks and quarters. Rashesh, hi, good morning and good speaking with you on the show. Before I ask you about your own business that has seen, a big leap over the last 6 to 12 months, I wanted your view on the market because we're sitting at new highs. We have a lot of participation coming in from a gamut of heavyweights. What are you seeing on the domestic retail end? Is there fresh money being pumped into the market and a lot more optimism since the last time we spoke?
Yeah, I think in the last couple of months, in spite of the US Fed hike and all of that, I think optimism is fairly high, and we're also seeing fair amount of improvement in the underlying conditions. The economy after demonetization has bounced back very significantly. It just shows that the underlying resilience is very strong in the economy. The last quarter earnings were not so bad as expected. I think even this quarter we think is going to be a fairly good quarter overall. And if you see, even globally, growth is coming back, all the economies are bouncing back, and liquidity conditions have been as good as they've been. We have a lot of surplus liquidity. Along with that, a lot of retail investors, especially Indian households, have started significantly shifting away from real estate and other hard assets into equity markets. So we have all heard about SIPs now hitting 40,000 crores a year. So I think both through the primary markets as well as through the mutual fund segment, we're seeing more and more retail investors coming in. Global liquidity is very strong. FII flows have also been very robust. So given all these conditions, I think the market seems set for a fairly strong base right now. Of course, now everybody is going to wait for the RBI policy in the coming couple of days, as well as the Q4 earnings, which will be out in the next few weeks.
Okay, Rashesh, good morning. What would that mean for NBFCs? You yourself had a big NBFC now, of course, and we have seen, some of these stock prices double or treble over the last 6 months of 1 year. You think with so much emphasis on financial assets, do you think this space could grow even from here?
Yeah, if you see overall, the credit market is growing, though we all look at only bank credit. But I think in the last 2 years, what has significantly changed is credit has moved away from bank credit. In fact, recently there was a report which said only about 25% of incremental credit comes from the banking segment. And we are seeing NBFCs, we're seeing the bond market also becoming very robust. And I think in a way it is a good thing because NBFCs are able to capture the new emerging segments where credit is required. Because we have the conventional segments where there is easy credit available, but there are a lot of new emerging segments in terms of microfinance, in terms of SME, in terms of rural finance, in terms of even individual loans, which are hard to get. So I think the emerging segments are showing a lot of robust growth. The surplus liquidity augurs very well for NBFCs because NBFCs' cost of funding can come down, which they can pass on to the consumers. And along with that, the growth of the bond market. Bond market last 3-4 years has been growing at more than 20% a year. And that also augurs very well for NBFCs. So I think increasingly, we are seeing all the signs which are being set up. And I do think that the Indian credit growth will continue to be at about 13 to 14% a year, which is very low than historic numbers. But even at 13-14% a year, NBFCs should be able to grow at 18-20% a year. And what we have seen last 3, 4, 5 years, the growth of NBFCs has been in that range.
Okay. Rashesh, we'll do one thing. Parameters over the last couple of months have been very strong, especially loan growth, 32%, etc. But going ahead, what kind of expectations can one have?
See, going forward, as I said earlier, we do expect credit growth to remain robust in India, and especially credit growth which is outside of the banking system, because we're seeing this a little bit of the bank, disintermediation, largely growth of the bond market, the excess liquidity that is available is making it easier. But along with that, we're seeing a fair amount of growth coming back in capital markets as, flows into both insurance companies and mutual funds have been very strong. FII activity has been strong. So we're seeing a fair amount of activity in capital market, both equities and bonds. And along with that, actually asset management, wealth management also another very big growth areas. We estimate that the Indian wealth management market is growing at about 30% a year, because as you know, asset prices are going and the affluence is growing, we're seeing more and more people, HNIs, UHNIs, even the mass affluent segment in the wealth management is growing. So I think we are at that sweet spot where credit is growing in an organic way, but the non-credit segments like asset management, wealth management, capital markets are also showing a fairly high amount of growth. In fact, some of them are growing even faster than the credit markets.
Okay. I want to ask you about ARC, Rashesh. Starting today, it will be 50% that all will have to buy of an asset. How is the growth likely to be affected? Will the business go down?
I think it will be very asset specific, because in a lot of cases where we have seen that banks have already provided for that asset, if they have already marked it down to 50%, because as you know, the 50% only applies to the provisioning norms. You can still do 85 and 15 with the banks, but if the banks own 85, then they have to follow the provisioning norms that they would have to follow as if the asset is still on their books. So I think it's a provisioning issue, and what we are seeing, we are already in conversation with a lot of banks. In quite a few assets, there have been fairly fully provided assets, fairly mark to market has been done. And in those cases, I think there might be still opportunity for 85-15. If it goes to 50-50 also, I think it's a pricing issue. We on our side in Edelweiss, because we have allocated about 4,000 crores of our own capital for the next 4 years, and we have another 5,000 crores of capital available from our partners, CDPQ, we have a fair amount of capital cash available that can be deployed. So even in the 50-50 scenario, as long as the pricing is right, as you know what happened when we moved from 595 to 1585, a lot of transactions got done, but the pricing had to be adjusted. I think we're seeing the same thing. We're going to see this again, the same thing in this.
Okay. Well, actually, Mrs. Bhattacharya will start speaking in a bit, but we will cut to her in a little bit. I guess it'll be initial pleasantries. But I want this very crucial question answered from you, Rashesh. Uday Kotak recently said that he is very keen on building a big ARC business and that he's looking for partners in that. Are you all speaking to each other? Will we see some kind of a JV?
I think no. I think because here, I think a partnership with an Indian company may not bring a lot of real value. I think Indian company with foreign capital, especially pension funds, insurance companies, brings a lot of value, because Indian companies have the skill set, the foreigners have the capital, and as we have done with CDPQ, we expect quite a few more of those will come out. And I think overall it will be a good thing, because we think over the next 3 years, the ARCs and the other capital providers will need to provide about 150,000 to 200,000 crores of capital, not just for buying out the bad asset, but also for the priority funding and the additional funding that is required, that is going to be required to revive a lot of these assets. We're seeing a lot of growth area in that RE area also of giving additional capital to the companies to increase their capacity utilization and revive them.
Okay, Rashesh, you yourself are known for looking at some M&A candidates. Anything that stands out? Anything that you're eyeing right now in terms of any big business spaces?
As of now, as you know, we just acquired the JP Morgan Asset Management last year, so we've just completed the integration of that. And our approach to M&A has been that if it's strategically important and if there is a right size, the bolt-on, we like a lot of smaller acquisitions rather than one very large big one. Currently, we are not seeing any in the horizon, but we are always open to scaling up all our businesses through acquisitions and all as the opportunity arrives. But as of now, I think our idea this year is to focus on a lot more organic growth, because as you know, last year we have been clocking more than a 40% growth on a YOY basis. We want to continue with that.
Okay, Rashesh, we have lots more questions for you, but to the beginning.